I always say this to any students who take me seriously. There's a difference between a trader and somebody who trades. Alright, so let's go. Let's talk about the correct way to analyze a chart. Now, something I want you to understand. Before we even get into analyzing a chart such as this, we have to understand what is a chart. A chart is a mixture of data or a combination of data, right? Now, if I asked you to break down for me what it is that traders get paid to do, what would you say? Most people would say something that they buy low, sell high, or they buy assets and they sell assets, and it's always a combination of what exactly traders do. But nobody can really define it in words, right? In the correct words, I should say. What I would say is, as a trader, you are paid to analyze data. Now, keep in mind what I am saying. This was a lot of merit. That being said, should you be paid for the data that you don't analyze? No, you should not. So in other words, if you're not paying attention to all of the data on the screen, as in all of the different data points, remember, structure is a combination of elements coming together to create one thing. If you're not paying attention to all of the data elements of the structure of the market, you shouldn't be paid for that. What I tend to try to get people to understand, traders to understand specifically, is when you're only looking at trend lines, or you're only looking at support or resistance, or you're only looking at Fibonacci's, or you're only using like 2 or 3 of these things, what about all of the other things that happen on the chart? What about the highs and the lows? What about the sessions of the day, the times of the day, the days of the week, any fundamentals, any news events that might come out? What about the candlesticks themselves? What the individual candlesticks are telling you? Any indicators that you may or may not have on your chart? What about where the liquidity pools are, right? Where the traps are, where the dealer is setting these traps. You understand? Where the highs and the higher highs, higher lows, lower highs, lower lows, trend lines. All of these things are things that you have to take into consideration when you're trading. Because if you do not, guess what? When you leave out certain things in your analysis, you should not be paid. You should not be paid. Think about it. Realistically, you should not be paid. So for me, what I tend to do is when I am analyzing, and anybody who knows me knows that I analyze like really, really quickly. You know that when I'm analyzing, I'm able to see in like lightning speed what it is I'm looking for. And then when I kind of get an idea as to, okay, yeah, I think I want to take this trade, I would then slow it down and then start to look at the individual elements of that particular chart. What is really, really unique about my approach is I'm just generally scaling through everything and looking to see if there's a general alignment of my certain criteria that I want. And only when I see something that looks pretty good, then I slow it down and I say, right, let me start to look at each of the individual elements to see if they are there or not. What a lot of traders do is the exact opposite. They tend to go in so in depth on just 1 or 2 elements on one currency pair, and then they get cognitive biases. They create cognitive bias for themselves where they say, well, this particular currency pair looks bearish, so they start to draw trend lines, and then they say, right, well, it looks like it's on a trend line right now, so it makes sense that it's going to continue to sell, and then they just look for sells. The problem with that is you're not paying attention to all of the other criteria that are happening on the chart, and that leads to problems because all the other data on the chart might not be alluding to a sell right at this moment. That's just the way I look at it. So for me, the correct way to analyze a chart is you have to pay attention to all of the data points that you're allowed to look at, right? As retail traders, we are allowed to look at certain things. There are many things like actual liquidity pools that we are not allowed to see, but you can get a general gauge as to where they are by virtue of looking at where the masses are entering their positions. So for me, I'm using these things based on what I understand about the market. I'm using these things to kind of get an idea of, okay, this is where I think there's a liquidity pool because there are a lot of people entering here. This is something I want to pay attention to. If there are a lot of people entering in this area in particular, then I don't think that's a safe area for me to enter. And that's just how I do it. And you have to combine that with everything else that you're looking at, because if you don't, guess what? You'll be just like everybody else, doing what everybody else does, losing like everybody else, and then you're wondering why Forex doesn't work or why trading doesn't work. It doesn't work because you're not working. You get paid for the data that you analyze. So if you don't analyze data, don't expect to be paid. I always say this to any students who take me seriously. There's a difference between a trader and somebody who trades. It could be somebody who, you just open MT4 or Trading View or whatever and you just decide, yeah, this looks good, let me take this. No, that's not how you're supposed to do it. I can assure you that is the quickest way to failure. You need to be a trader and think like a trader, analyze the data that is in front of you, because if you do not, guess what? Don't expect to be paid. So I'm going to quickly jump onto my chart right now and show you what I mean by you analyze all of the data points. So let's go there quickly and let's see what I'm talking about. So this is CADJPY, and what I really want to talk about is, remember, like in the earlier half of the video, I was saying that you need to pay attention to all of the elements on the screen. You need to pay attention to all of the data points. What is very important, and you can see this, you have an entire chart. My friends, my brothers, my sisters, you have an entire chart. Why are you only drawing trend lines and calling that judge? Why are you not paying attention to everything that is on the chart? So let me show you some of the elements that I could actually identify here very quickly. So the first thing, obviously, that is very easy to visualize is a trend line, an overall bullish trend, right? So you have one tap, two taps, and you could even say that maybe it's creating one here. But what I'm actually, if I were to zoom in, this is a forward time frame. If I were to zoom in, right, this is not, I'm not showing you a buy or a sell or anything here. I'm looking at certain criteria. I'm looking at certain things. I'm looking at lower high, high, lower high, you have a lower low, you have a lower high again, you have a lower low, right? Lower high again, lower low, and then all of a sudden you have a higher low, right? Then, well, at least than this one. And then it keeps on going up. So now all of a sudden, this here has been broken. So when it was in a bear trend, in this case here, right, that bear trend has been broken within the macro bull trend. Now, remember, we always want to pay attention to what is going on macro, right? So this here will tell me that at this point in time, right, obviously adhering to the overall structure of the market, the overall direction of the market, I should say, this is telling me, right, it's respecting this big bull trend here, so that's good. That's good news. Another thing that I can take into consideration is the way that candles are closing. Now, again, this is the forward time frame, and I typically don't enter up here. But what if this was the 15-minute time frame? You could actually start to realize that candles are actually starting to show signs of extreme bullish momentum and then bearish rejection. Bearish rejection in these candles in particular. You can see that this is a bearish candle, but it's bullish by nature. Yeah? It's a bearish candle, but it's bullish by nature. We know this because it went downward, rejected the downside, and is starting to go up. And that is confirmed by the very next candle that opened bullish and closed bullish, right? So that's another element on the chart. Another element that we can actually take into consideration as well is this previous high here, right? Remember, I said at the earlier part of the video, highs and lows play a very significant role in overall market structure. If this has to reverse and create a big bear move, it makes sense that the dealer, which is another element by itself, take out this high first and foremost. So when he does not take out this high and he's not necessarily reversing the market, you can see that it's in a bear trend. This bear trend is not telling me that it's going to break this macro bull trend, for the reason being that I know that there's trap liquidity up here. So what I'm waiting to do is wait to see price get back to this area, and only when it gets back to this area I would then decide, okay, is it rejecting this area? Is it exhausting? Is it what is it doing? And if you realize, it's actually doing neither. It's actually accumulating on this area. What is it accumulating? Orders. So with the accumulation, what actually ends up happening is it looks like a move like this, where it moves up and down, 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 and then all of a sudden it breaks. Now, the biggest thing here to take into consideration is where this accumulation took place, because you can see this accumulation happen anywhere, but where you want it to take place is on a previous high or previous low, because if it has to reverse, it's not going to stay here for very long, because if it stays here for very long, obviously it's giving the masses and the majority of the market an opportunity and time to get in for a sell at a really good price. That doesn't make sense from the dealer's perspective. The dealer isn't in this business to make you money. He's in this business to make himself money. So this is just like, and you see how quickly I'm looking at all of these different criteria. I can open more or less any chart and do this for you in no time at all, because you have to pay attention to what all of these criteria are telling you. Now, how would you use this in a live scenario? What I would say is, from the time I realized that this high here would have been broken, from the time I realized this lower high would have been broken, I am now in buying mode because I'm already overall bullish, right? Then I'm seeing, well, a bear trend here that's no longer valid, and now it's back in bullish momentum again. I'm seeing bearish candles being bullish by nature. I'm seeing big engulfing candles. I'm seeing that it has to get back to this high. All of these signs allude to the buy. So nothing about CAD JPY at this point in time would have told me to sell. Now, does it mean that I would just randomly try to buy it because of that exact notion? No, you're still going to go down on a lower time frame and look for a proper entry. But the main thing is you understand the direction by virtue of actually paying attention to market structure. And if you realize, at no point in time did I mention anything with regards to the moving averages. The moving averages are only an entry tactic or an entry criteria. The moving averages mean literally nothing in this case because I already know the general direction. So when you think that it is a moving average strategy, you'll be vastly mistaken. You have to understand market structure and understand how a moving average might relate to that, not the other way around. People say that, they trade market structure by higher highs, higher lows. No, you have to pay attention to all of the criteria. And I could go even further in depth, right? And the further and further and further I go, I could go down the rabbit hole starting to show you how individual candlesticks are forming and what they are telling you, right? But the main thing is just understanding a general direction by virtue of looking at higher highs, higher lows, and what should happen at previous highs and previous lows. It is much more than what most traders, or people who trade, I should say, would use in their analysis. So, yeah. I really hope that you enjoyed that one. I hope that it made some sense to you, right? I hope that you watched this video all the way out, all the way to now, right? If it is you like this kind of stuff and you like me to break down what I think, what I see as a trader, how I approach the market as a trader. If you like that kind of stuff, this kind of style of explaining things about the industry, be sure to hit like, subscribe, right? Subscribe if you want to see more, right? Comment below, what do you think? Do you agree with my approach? Do you agree with the way that I'm approaching the industry, right? And if you have any questions, don't be afraid to reach out to me directly at EkataTrading via email, TikTok, YouTube, Instagram, and Telegram. Any way you want to message me, you can message me. I'm always ready to answer any questions. I hope you enjoyed this one, and I will see you in the next one. Peace out, guys.